when and I wanted to sorry about that, and I wanted to introduce something that hasn't been discussed in a bit, and I want use of the option market in a report or a potential um, event that may happen, and how to use the option market in order to maximize the Wyckoff ability to read the market either up or down. So we use our Wyckoff technique, try to get an area where we're ready in the ready position for the trade, either up or down. And we can utilize that as well. So what we want to do is when if you want the market to go up, we like to buy a call option. If you want the market to go down, we want to buy a put option. A call option is a right to buy the strike price you choose, but not the obligation. Your risk is the amount of the option cost plus the fees associated with it. If you want the market to go down, you'd want to buy a put option. You have you can have the trend here is been going down, but lately it's been going up, and we're about mid range. So I'm going to say that trend is going to be neutral. But my buying is present over the last several weeks. So if I have buying there, legitimate buying there, I'm going to see the market get bought and close maybe mid-range to higher. Bought, mid-range get higher. That would be the accumulation phase in the market. So I look at this chart and I say, wow, the high of the stock, this high has been 154. Okay, approximately. That's the whole retrace. And then I look at the next market where the market came down, and I look at the market right here. And then I put the marking down here. Subsequently, my put option would be if I think the market goes down, I'm going to put the market that goes here. And I'm going to put a market that goes here. Okay. So the prices that I would think the market would go to. I'm bullish. I want to buy an option when I think that market is going to move up or down. This week we have earnings. I believe in a lot of NASDAQ stocks, so people look at the option market to play it. In this particular place, I like to buy the market, and I see some type of Wyckoff bullishness. A market makes a low. There's a spring here, so this is a viable trade, an edge of the spring, a penetration of a low and a spring. Okay, the market moves up, absorption go higher, for a little shorting of the downward thrust. Number 2 area by the market, right there. So I have buying in the background that I can buy both markets. Then today, currently, I have what we call a springboard too. A penetration of this low as a spring near the resistance area, like a diving board to go up. So I like this chart. I'm bullish. I think higher. I could buy the 155 strike price. I'm not sure there's one, but let's just say for 155 strike price, I could buy the 150 strike price, or I could buy the 140, let's say 146 option price. So this option price would the lower the price, more expensive. Let's say this is worth 3. Let's suppose this is worth 2. Eventually it'll be worth 2. 2. And the third one, we guess, will be 3. Or I can do better. So 1, 2, 3. Okay. Now I have the actions in reverse, but okay. So the strike price here. Okay. So this is the pricing. This would be $3. This would be $2. And it'd be $1. The further away you go, the option is cheaper. Makes sense, right? But percentage-wise, it's more expensive because this market has to go to 154. Here, the market has to go to 156. So if I buy a 146 strike price and it goes to 154, it's worth 8. 154 minus 146 is 8. But I'm only paying $2 more. Better off buying the one that can go to 8, right? So buying the more expensive option near the strike price is the way to buy an option. More expensive, but if you're right, the market gives you better, more bang for your buck. If you're wrong, you're able to liquidate it with a loss, maybe more in dollar wise, but percentage wise, probably not if you get out at a decent time. So buy the strike price as closest to the money as you possibly can. Okay, versus when it's further to flyer. You want the market, the option to go into the money as quick as you can. Do I have a setup? That's right. Yes, I have a springboard here. And the springboard occurs when the market is at resistance and go higher. If I take my potential of sideways count spacing, if this market should at least test the one area. Well, I'm gonna buy $3 one. If I'm right, I want the market to go into the money as quickly as possible or above the strike price possible. So this is a setup, a spring. This is the potential of the move up, and I know my risk is 3 criteria: the objective, the loss that you can sustain, the time worth the decay, the option price. Is the market ready for setup? It's not ready for setup. It may sit there. The problem with the market sitting there is it's like a car. It decays every year you get it. Under 30 days, when the option percentage-wise gets shrinking, smaller and smaller, we lose more percentage-wise risk. So buy it outside the 30-day window. The strike price is close to the money as you possibly can. It's more expensive. So if you want to buy the 146, but sell the 154, you could bracket between 146 and 154 price. It limits your gains, but a good percentage of if the market moves up, you're going to do well. So buy the option. So this market is ready. It's pre-possession. This is a live chart. This market should trade back up to the 164 level, 154 level. And then when if it goes to money, you have the right to be long from 146. Market at 154. You're up $8 on the stock minus the fee that you paid for the option. It's the best strategy that you could do an option. In this particular case, the market, if you think the market may go down, then you want to be able to sell, buy this option, lower one down. But this is a bullish formation because of the spring formation. I want to thank you for listening to this little option earnings season. They have that going on. And hopefully you buy the setup or sell the setup, the Wyckoff related, close to money as possible. Have your objective, liquidate when you feel the market has reached its potential. Thank you very much. Again, my name is Gary Fulleth. Thank you.